Hello traders, Gary Wagner here, just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, October 28th, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combine it with trending markets to give you an overall sense or feel for what occurred in the market this week, as well as our forecasts next week. And what a week we have seen in the markets, and what quite a finish nonetheless. Gold closing on a solid note for the week and a solid note for the day, closing up around $6.50 at $12.7590. That's basis December COMEX contract. We have seen a trade to a low of 62 and a high of 85.40. So we have certainly seen quite a range in the marketplace today in regards to the gold market. Now, of course, spot basically at the same point, around 1275, 1274 and change, 1275. As you can see, it is still actively ticking as well as printing today. Over to silver. Silver closed up substantially higher, a three-quarter% gain at 1777. That puts it up about 13 cents on the day. That, of course, is COMEX most active futures. It traded to a low of 1750. And a high of 1793. Of course, we do have an active trade on. We are long gold from 1259, so we've got some decent profits in the market. On today's video report, we want to talk about our exit strategy and levels of resistance we think gold could go to, and where we're looking to get out and how we want to work with our stops. That's all on today's weekend review, which starts right now. So traders, first chart that I do want to look at on today's show is a simple candlestick chart. It is a weekly candlestick chart of COMEX gold. We can see that without a question of a doubt, the last couple of trading weeks we have seen this market move higher, and we have seen the market move higher off of the lows that we achieved back roughly, well, a month ago at this point, or the beginning of October, when the market came down and tested 1240, which would be this area right here. If you recall from those weekend reviews as well as our daily report, as this market was coming down, we were looking at an appropriate place to enter along, and we based it on two Fibonacci retracements that were very close together and formed what we call a Fibonacci harmonics. In fact, let me add the second one now. And traders, as you can see, I have added a second fib retracement. Now, the two fib retracements, one begins at the low that we achieved during the year, which came in at the beginning of the year, up to our highs of the year, which come in at around 1375, roughly in there. And then from there, we're plotting a 38% retracement, and that retracement takes us to 1250. The second fib retracement that we are putting into this equation really starts at the bottom of this market at around 1200, and that occurred middle of May, up to the same record top. And then we calculate a 78% retracement because these lows actually exceeded the 61% retracement. Now, when we do that, we've got a basic band, a band that I'm labeling as a fib harmonics. And the key with the fib harmonics, let's go in and highlight this right now, but the key with the fib harmonics is that as long as it stayed above this particular band, I felt that this was a really good place to really look for support. So we did go in this market. We entered this trade on the 13th of October, and our entry price, call it roughly, was about 1260. And that would be right in here, and that occurred during this candle when we actually entered into the market, or excuse me, that we actually got into the market on this red candle and had a little bit of heat the following couple of days. Now, the market, of course, is well above that. We're in at 59, market is at 77. So the real question has to be, at what levels are we looking for resistance and what our exit strategy is? And to do that, the best way to do that is to look at a daily chart. Let's go ahead and pull that up. And so traders, I've just gone ahead and pulled up our daily chart again, standard candlestick format. We've got a couple of different areas that we want to follow on. Now, on this particular fib retracement that we have in here, it's a little bit different in that we start from 1374 and we take that down to this particular bottom. Let me get the proper pointer here, but we start up here at, as I said, 1374, and we take it down to this bottom at about 1242. And then what we can do from there is get different levels that could come in and actually be a resistance area for the market right now. Now, the minor level of resistance that we were first looking at, and we talked about this over the last couple of days, that I didn't believe we'd have too much trouble getting through that, would be 1273. Market looks like it is closed officially at about 1277. So we certainly have closed above this particular line. And as you know, my exit strategy on our particular trade was to get in around 1259 and look to get out around 1300. Now, the next level of real resistance that we could really come into, and this, of course, is provided the market continues to rise next week, which I believe it has a very, very high probability of doing, is going to be about 1292. That is a 38% retracement, and it's a 38% retracement, as I said, from the correction from this high down to these recent lows that we got at the beginning of October. So that being said, our recommendation is obviously to maintain your current long at 1260, 1259 and change. Maintain your current stop. We will look to move that stop up on Monday or Tuesday. And the price point we're looking at, as I talked about just earlier this week, is around, call it 66. After the last couple of weeks, well, let's say since the beginning of October, the dollar has just been on fire, an accelerated upside move that we believe could be at a short-term top. Today, we have some weakness in the U.S. dollar closing off about 0.5% on the day at 98.32. And we've gotten our first signs that we could see this dollar head to lower pricing next week. Let's go ahead and take a look at a dollar chart. So traders, we are looking at a daily chart, standard candlestick format, U.S. dollar. Hard break in the dollar today. Of course, we saw a couple of days earlier this week in which we felt we were either looking at the market at a key pivot point or key reversal point because they were dojis, or simply a consolidation area, a rest area. And what I mean by that is you can absolutely find occasions where these small-bodied candles, such as dojis, will occur at the tops of the market or the bottoms of the market. They are absolutely pivotal when it comes to the exchange of power between the bulls and the bears, because what a doji says, in essence, and the wider the range, meaning the wider the tail, the distance between the open and low and open and high, the greater the battle was during that particular market session. But what that says is with that wide range, there was a real tug of war back and forth between the bulls and the bears, but ultimately neither the bulls nor the bears could dominate in terms of keeping control of the market. And so therefore, it's something we always look for. However, when we did see that on the following day of these dojis, we had yet another move to the upside. That's his green candle. And it wasn't until today that we got a really hard break in the market. Now, we've also added a bullish channel lines, and they're called linear regressions. It's set at 66 days in terms of the cycle, and it's based off of the close of the market. And we can see without a shadow of a doubt that ever since the market hit these lows, and this would be back at the end of September, beginning of October, and that's when we really got this accelerated move of the U.S. dollar in value. It seems as though now that we've hit the top of this line, we have effectively seen our first real instance at the top of this channel line of the market finding some real resistance, some real weakness, and in fact, traders, we could now see the dollar move to lower pricing throughout next week. Ever since crude oil prices hit 52, and it hit 52 very, very recently, we have seen the market backslide down more today, well under $50 at this point, 48.76. That's off about 1.5% or about $1 less per barrel of crude oil. Let's take a look at a crude oil chart. So traders, we are looking at a crude oil chart, daily chart, standard candlestick format. When we look at this chart, and if you recall from our show of a couple of weeks ago, we had pegged a ceiling or a price ascent that we felt crude oil could go to between $50 and $52, which is precisely where the market went to on its way up. It formed this double top at this point here. We've got another top right here, and at that point began to track lower. It has now tracked within the channel, breaking to the bottom of the channel. But here's what's interesting. Take a look at this top that we had recently, and this came in about the middle of August of this year, roughly at $49, $48.92. Draw it across, and what you'll see is this. We closed at $48.77. This is at $48.92. So we're just a little bit below this price point, which tells me that if we get any kind of weakness, which I believe we will, going into next week's session, we really have nowhere to go in this market but to test this next level here, which comes in roughly at $47.75. And that's what I would look for next week in crude oil. So traders, we are looking at a daily chart. This chart is of COMEX silver, and COMEX silver closed up about 15 cents today at $17.78. As you know, we entered long positions in the gold market, but we kept out of silver. In particular, I was concerned with the volatility in the market, and I had believed that we would see gold outperform silver. Now, I have stayed out of the silver market based upon this following study, and that is a simple trend line drawn by fixing these lows here and then carrying this particular line up. When we had this hard break that came in both gold and silver, we had a much more dynamic break in silver, breaking below this long-standing support line. Now, I believe it's resistance. Now, as you can absolutely see, over the last week and a half, this market has flirted and attempted to really go in and break above that, but to no avail. And so I am still under the belief that until or unless we see this market break above this particular trend line, we're going to be sidelined on silver. However, if we see the market carry through next week and have a solid break above this, we will probably add a long silver to our long gold mix. Traders, as we close out this week, there's absolutely no doubt in that we have seen, I believe, on a short-term basis, the bottom in terms of precious metals prices, specifically gold. Over the last couple of weeks, ever since we put on our position on the 13th, we have seen this market, if not moving higher at the beginning, absolutely forming a base and some solid support at the areas that we identified and talked about at the beginning of the show. And that's roughly between about 1238 and about 1250. There's definitive support in that area. Of course, we took a position on at 1259.60. We went long. We have stops below that. At this point, we do have some nice profits as the market is at 76, so just shy of $20 per ounce on our contracts of gold. My recommendation is obviously to maintain our current long gold position, to maintain our current stop. We have talked about all week the level that we want to move our stop up to, which is approximately 1266. We'll look to do that next week. I just want to have a little bit more room under us, considering the kinds of moves that we saw in the market today. We had some real volatility, and I want to make sure that no matter what the range is, that wherever we move our stop, if in fact the market continues to move higher, we continue to ride the bull. This has been Gary Wagner wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.